Hey, good morning, everybody. Welcome into Wealth Watch. Good to have everybody back. Before we get going today, I did have two things I wanted to cover. One's kind of a housekeeping item. The other's related directly to our topic today. With the world reopening, summer vacations starting up, et cetera, I think you're going to see us pare back the frequency of these broadcasts to more of an every 3 weeks, every month type schedule. We've been so pleased with the number of views we're getting, the interaction that we've received. That's really been awesome, and thank you to those of you who have been attending. We really appreciate it. Secondly, we're going to be discussing annuities today, and I know a lot of times when we come on here, we say that we're addressing things generally, or we say, don't necessarily take this as advice. Everything's customized, and we want to have a one-on-one conversation. Now, while that last statement holds true, even as it relates to annuities, I will say WealthSouth as a firm, our philosophy is built on discretionary management. So it is really going to be an outlier situation where we're going to advocate for the use of an annuity within our portfolio structure. So I do want to make sure that those of you viewing this understand that at the outset. But we do want to take the time to make sure that everybody does have a good handle on how annuities work, what they are, et cetera. So that's why we wanted to make time for this today. And I've asked John Cadwell to join us from our office, and the reason I asked John is he's over the last few years, he's been in a position where he's seen annuities from kind of every vantage point. He's had clients who've received proposals and wanted to get his take on them. He's had clients coming in with pre-existing annuities, wanting to know, did those fit within the overall portfolio structure, or how do I unwind this and get out of it? So John's been very well schooled in this over the last few years, just the ins and outs. And so John, thanks for taking the time to join us this morning.
Well, thanks for having me. Excited to talk.
Absolutely. So I know everybody thinks, yeah, I know what an annuity is. I'm pretty sure I understand it, but why don't you take a minute as we get started here and just walk through what I would call annuity basics.
Sure. So annuities are more or less a contract with an insurance company where you have three parties. You have an owner of the contract, the annuitant, which the contract is based on that person's life, as well as a beneficiary. So that's kind of the three main players with annuities. Because they're owned by insurance companies, they are taxed and treated a little bit different than a traditional investment structure. So we're going to highlight that here as we move forward in the conversation.
Very good. So as a jumping off, obviously there are different types of annuities out there. Talk a little bit primarily about some of the more common ones we see.
Sure. So over the last few years, seen a lot of fixed annuities. That's a good place to start because they're not terribly complicated. It's an easy place to highlight how annuities do work. And essentially a fixed annuity is you're giving your money to an insurance company for a certain period of time, and they are paying you a return on that, an interest rate return on that until the contract matures. Some of the benefits of a fixed annuity would be, and annuities in general, is the tax deferral nature. So until you pull the annuity out, it will continue to grow tax deferred. The downside of that, however, that a lot of people don't realize when you're buying these is that when you take it out, it is actually taxed as ordinary income, which is a big consideration when you look at the different options for you. Some other things to keep in mind with fixed annuities, while we don't see them as often, there are pretty big penalties to pull out. You can typically get a little bit better return than a CD type structure. I mean, again, most of the people buying these are going to be pretty risk adverse. So those are some of the ways that a fixed annuity would work. Most of these that I've seen over time, people just bought them and they either really like them and they're going to continue to buy them, or they bought it and realized that, this just isn't very exciting. I've got limited upside. Yes, I'm not going to lose money, but in essence, I am if the market's doing well for an extended period. So, that's typically what I see with fixed annuities. Again, not terribly complicated, but a pretty nice way to highlight how annuities in general just work from a tax standpoint, et cetera.
And are there other options kind of in the general annuity structure outside of fixed?
So one of the ones I really wanted us to spend some time on are actually indexed annuities, and we've been seeing these pushed out a lot of late. The idea behind these are to also give an investor the opportunity to not lose money, so they have the downside protection. And the index annuities do have more upside than a fixed annuity, but the way they work really go well, I guess, when playing on fear for annuities for a buyer. So with all this market turbulence that we've been
Hey, John,
yeah,
let me stop you right there. When you say preying on fear, is that why we've likely seen a little bit of an uptick here recently in annuity proposals, or more advertisement around annuities?
I think so. Again, people that have watched their portfolio balance move down over the last few months. Obviously that's uncomfortable, but that's also just a point in time. And taking an indexed annuity, basically, let me explain how an indexed annuity works, and I think it'll make more sense. So basically, an indexed annuity, you are guaranteed to not lose any of your principal. So you've got a zero floor is what they call, and then there's a ceiling or an upside cap of a certain percentage. So you've kind of got this narrow band that of late has been coming down. So you've got people that are pushing these out saying, okay, well, we've got something that you cannot lose money buying. You've watched your portfolio go down, maybe try one of these. When we just don't necessarily think that makes the most sense long term when you look at the cap rates on these. So let's just say,
John, you mentioned the cap coming down. Talk a little bit about why that happens.
Yeah, so just a couple of years ago, the caps on these. So the index annuity will track something like the S&P 500, and just a couple of years ago, those cap rates were decent. I saw a number of them in the 6% ish range, and for downside protection, that's not a terrible place to be for a select group of investors. But as interest rates have come down, even though they don't totally correlate with the S&P, we have seen these annuity companies drop those caps of late, and so you've got this really narrow band. And I've got a perfect story to kind of illustrate how this works. And,
sure.
And actually, I'm sorry, I've actually overlooked one thing. The way the interest is calculated, so similar to a fixed, you have to hold it for 5 years, 7 years, a certain period of time. But with index annuities, they do what's called point to point. So if you bought it today, 1 year from today, whatever the S&P was at, you would get that return. If it's negative, you get zero. If it's between that band that we discussed, the floor and the cap, you would get that amount. If it's over the cap, you would get up to the cap. So had a situation recently where got somebody I work with that has one of these. The anniversary date is April 1st of April, and looking at over this last year, coming into February, we're a month away. The client's anticipating they're probably going to get the max payout. It understood why the person bought it, didn't have a lot of investment experience, didn't want to lose money. So then, COVID-19 hits, the market drops, S&P is down, and all of a sudden April 1 comes and the client gets zero. Now, we that have managed portfolios would understand that person's actually ahead by getting zero if they'd been in a mutual fund at that point in time. But the client was, obviously disappointed. And so that's kind of a tough way to calculate the interest in these things. Now, I also wanted to explain, let's just say that we didn't have COVID-19 in this instance. And I don't know the exact percentage the S&P was up from April 1 of 19 through what would have been 20. But if COVID hadn't happened and we'd stayed at these levels, the S&P was probably in the, 15 to 20% range, somewhere in there, definitely above the cap. The client would have gotten there, 6% and missed out on all that other upside. So if the market is smooth along the way, these can make sense. But we've seen so much turbulence the last few years and volatility that it can be disadvantage. It can have a disadvantage to people that buy it as well.
So with all that in mind, you mentioned tax deferral. You mentioned the downside protection. It seems like there are pretty compelling reasons why people buy, but it seems like there are also pretty compelling reasons why they should do a more thorough analysis. So how do people end up in these structures?
Yeah, I think, again, some of the things that you highlighted are always brought to the front. I think you hear people that are, selling annuities regularly are really hitting on the tax deferral nature, and they're not necessarily looking at down the road. If you do a further analysis of what your actual dollars would be when ordinary income tax comes out, that certainly impacts the overall return over that period of time. Pair that with, in this situation we're in right now, while we don't know what tax rates are going to, I think most of us feel like they're likely going up. Not being in an annuity structure, through a managed portfolio, taxes can be managed along the way. You've also got, capital gains rates are significantly lower today. We don't know those will always, that'll always be the case. But, when I look out down the road, as people are being through these proposals right now, I just really think it's important to look at every aspect, not just simply that I have downside protection and I can get more through this vehicle than, something extremely conservative. I just think there's a lot to consider. You've got to consider the tax implications and long-term nature of the product.
So maybe a little bit like McDonald's sells Big Macs based on how delicious they're supposed to be and not so much on how many calories.
That's perfect.
So we've hit on fixed and indexed annuities. Are there any other annuity structures out there that we see more frequently than others?
So there are other structures that we see. There are structures that don't have these caps or fixed these guaranteed natures to them. We see a lot of people that have bought these years and years ago, looking at a place to have a future income stream. And, what we see is a lot of these products are hard for the consumer to understand, and they're very much layered with fees. So, other products that are out there, you not only have to consider some of the issues that we just talked about, but you also have to consider the underlying fees as well. So yes, we do see other products out there, and honestly, those are brought to our attention regularly, and a large percentage of our clients have them. Again, they bought them thinking that at some point in time it would be a retirement vehicle that they could turn on an income stream.
So, and you mentioned the income stream, and I think you can probably answer this question in a couple of different ways, but one, I'd like you to address just when somebody does show up with an annuity and asks for our take on things, how do we help them assess that? And then specifically talk about some of the tools we have to measure that future income stream, and how that plays into our overall analysis. Sure,
really good question. So, what comes to my mind when you bring that up is a situation that we just had recently. Had a client who had an annuity that was not terribly old. There was a pretty decent gain in the contract to consider, but not major that they were completely stuck. And basically what we did is we took our planning software that we have here at WealthSouth, and we just ran an analysis and said, okay, so if we pull the funds out of the annuity, pay the tax, and start at this lower level in a well-diversified managed portfolio, what would be the future dollars that this money would essentially be worth down the road, and how would that compare to leaving it in the current contract? And so we were able to match up risk profiles between the two so that we'd have similar returns in theory over time. And what you'd find is it takes a little bit for the money outside to catch up after paying the ordinary income tax on those dollars. But at the end, this money was for a client who actually didn't want to have an income stream. They just were trying to grow the money to eventually pass to their heirs. And that's what you'd find is that, the ordinary income tax on the large gain potentially, assuming good markets, that the annuity had, just ate so much into the overall final dollar that, their decision was to move to a managed portfolio. I think that, our team and the way that we work with people and trying to do the right thing for everybody is it just makes a lot of sense. We are not here selling annuities. Yes, we're talking to people about, discretionary portfolios, but I think we can really walk a client easily through both sides of decisions and ultimately help guide them, but they can make the decision. It's usually pretty clear. So that's a pretty good example of how we would analyze an annuity for somebody.
So is it fair to say, whether you're going to ask us for some analysis or you're going to go to someone else, just make sure that they have that fiduciary responsibility? Yeah.
Absolutely. I mean, you really want to be with people that you trust and just, that aren't just trying to sell you something to make a quick dollar and then move on. We believe in a relationship approach long term. And if we talk to you about a vehicle like that can make sense in some situations, we want to be able to see you long term and not feel bad about that decision.
That's nice. John and I both apparently are receiving phone calls at the same time here. Well, John, thanks so much for the insight, the overview. I know that was certainly helpful. One thing to everybody watching today, I failed to turn on the Q&A. So if you do have direct questions, please reach out to whoever your appropriate contact is here at WealthSouth. Or if you are joining us today and you're not a client, please feel free to reach out to me directly at clint.long@wealthsouth.com. Thanks again for everybody for attending. Thank you for your support of this endeavor over the last few months. We have sincerely appreciated it. We will likely see you again in 3 to 4 weeks. And until then, stay safe and take care.